of what you need to do when working with private lenders on investment properties. So what is the process from your end and from my end, the borrower, when I come to you with a deal and I'm working with a traditional lender? And then let's just talk about some of the differences between that and working with an actual private lender.
Ultimately, because it's a private lender, they can do what they want, right? For them, it's an investment no differently than it is for you taking on their loan, so to speak, and acquiring the real estate property. So they don't have the same rules and restrictions and regulations that the banks do, and the credit unions and the kind of the B lender groups that are still institutionally governed and so forth. But they're not your top five banks, right? If you're truly a private lender, it's kind of the Wild West, so to speak.
All right, welcome back, everybody, to the Canadian Real Estate Channel. My name's Adam J.D. Martin. You guys have seen me here before on the channel. I've been partnered in business with Matt McKeever on several ventures doing real estate. I've done wholesaling, student rentals, Airbnbs. I've done private lending. I've borrowed privately. And today we're here talking with Ryan Carson from Carson Law. And we're going to actually talk to you about that subject of what you need to do when working with private lenders on investment properties. So Ryan, why don't you give us a bit of the background and some of the differences, maybe by starting to explain, what is the process from your end and from my end, the borrower, when I come to you with a deal and I'm working with a traditional lender? And then let's just talk about some of the differences between that and working with an actual private lender.
Sure. Yeah, absolutely. Happy to do that. Maybe we should start by saying, what is private lending, right?
Sure.
I'm sure most people watching this are quite familiar with it, but just in case there's some people, tuning in for the first time, which I'm sure there might be, or just getting into this. Private lending is essentially anything that's not a federally regulated institution. So if it's not a bank, not a credit union, or some other group and institution that's governed under the Bank Act or credit union legislation. So for example, like you said, if you were a lender and I was a real estate investor and I was buying a property and I needed to finance it, but I couldn't qualify or get terms favorable to me through the bank or credit unions as a public institution, I would turn to somebody like yourself as a private lender. So somebody who has money, whether they're lending it through their personal means or through their business that they might own and operate as a corporation, that lender, because they're not subject to the rules and regulations of the Bank Act and credit union legislation, is considered private. And so some private lenders, it's very simple and straightforward. It's just, Adam J. Martin, lending money personally as Adam J. Martin. But then it could be more complicated. It could be, Adam Co. And Adam Co. is lending me the money as a private lender, but as a corporation. Or there are private lenders that are actually even more complicated, where you've got what's called a syndication or like a mortgage investment corporation. And so there's layers to complicate what a private lender is, but essentially in the big picture, it's somebody who's not federally regulated by the Bank Act and the credit unions statutes and legislation. So hopefully that clarifies what a private lender is. So then the question really, I think, is from you guys is, what would you need to be, considering, as a borrower, if you're working with a private lender versus maybe the financial institutions? I would say for both situations, especially right now with how jammed up and how heavy the volume is in the real estate world, building in extra time for closings is very important. And that's regardless of whether you're working with a private lender or a financial institution. I think you want to be aggressive because you don't want to lose out on deals. And sometimes, doing a tighter closing timeline is what you need to do to get the deal. But I think you also need to be realistic and make sure you're building in enough time that you can actually finance the deal. There's no point signing up for a deal and getting yourself legally obligated to it and exposed to liability if at the end of the day you can't finance and close on it with your funds. So it's really important to, yes, be aggressive and be competitive in the bids for property, but be realistic and know your financing timelines.
How long are you guys taking right now to close deals? Like how long is enough time?
Well, I mean, normally if we were doing a purchase, we would love to see the paperwork and a file being opened and processed with, 3 to 4 weeks. Would be lovely, with all things being ideal and perfect. But, in reality, do we pull stuff out of the fire like with, 2 weeks, 1 week, a couple days? Yes. But, those are one-off, like shots in the dark type of thing that you really don't want to make your habit, right? I mean, if people need to pull off a miracle, then yes, we've pulled miracles off. We will pull other miracles off, but it's not what you want to make your bread and butter, right? You want to build out a timeline that's manageable and that you can repeat, right? Any really successful real estate investor will tell you, a good system with great protocols in place and the ability to make it repeat over and over is where you get your success, right? So being unrealistic with your funding timeline is one of the first, easy spots to trip up and have your deal really become a mess, right? So building in extra time right now, even with the banks, a lot of people used to probably have a lot of confidence that the bank deals could go really quickly, and it was the private lending deals that were the problem. From a longer time period, not necessarily a problem of like the deal happening, but just take a little bit longer because there might be more work to do. But to be honest with you, it's both lenders now because appraisals are really bogged down right now. It takes a lot longer to get an appraisal than it ever used to, or at least that's what we're finding. Other issues with it is some banks, depending on who they have working on the file, are more experienced in real estate investment deals than other representatives. And so you kind of, depending on who you get teamed up with at the bank level, if they know a lot, it can go really quickly and really smoothly. If they're less experienced, like anything in life, it can be a bit of a bumpier road. Just like if you team up with a really experienced private lender who's really good at real estate investment deals and dealing with real estate investors, you can get a private deal through quicker than a bank deal, right? Now, one thing to know about that though is private lending is usually a second option to the banks. Everybody wants the banks because you get like 2% interest rates or 3%, or I've even seen like 1.8s or whatever we're at right now. It's crazy. But that being said, if you can't qualify for that, you got to look at other options. Private lending would be one of them. And so private lending costs more. There's things to look out for with private lending is, you're going to probably have a lender fee, which is in the range normally of 1 or 2% of the loan amount, right? Is kind of an average. You're going to see a higher interest rate, right? Which you won't see at the bank. And most private lenders are interest only payments. So you're not paying down any of your principal with your monthly payments. You're only paying interest at that higher interest rate. And then almost certainly there's probably been a broker who's put this all together for you. So you're going to have a broker's fee, mortgage broker's fee. So the cost of private money, because it's kind of your option B, your second second alternative to financing normally. The main thing to note different between private lenders and financial institutions is the cost is going to be much higher, or at least somewhat so higher with private lenders.
Now, when I've done private loans in the past as well, I've found it to be fairly common practice where your borrower will actually end up paying a lot of the legal fees or all the legal fees in addition to those lender fee and broker fee. Have you run into that quite often?
Yeah, sometimes. Yeah, I mean, it certainly is possible. I mean, so probably to make sure you've got full, transparency and understanding of what you're, getting yourself into, it's really important to thoroughly review your, whatever your mortgage commitment is, or your term sheet is sometimes what the people will call the document. So very important, I think, to really examine and be comfortable with mortgage commitment or term sheet to make sure what are all the extra fees here. What's the term? That's always a really particularly sensitive one that can be very important for real estate investors, especially because lots of people will be using the private lending just as a short-term gap, like might only need it for a month or 2 or 3 months tops. And so they'll want to know the mortgage can be paid out and be open essentially. So there's no penalty fee if they pay it out before the end of the term. So knowing whether it's a short term of only a couple months and whether it's open versus closed, that's pretty crucial too, which is flexibility that you get with a private lender more so than your bank lends. There's not a lot of bank mortgages that'll sign up for something short term. They're in it for the long haul. They want at least a 1-year commitment, but most banks are looking at probably on average like a 3-year term, right? So, and they're typically closed as well.
Yeah, and I think something that's really important to stress while we're on this topic is, the idea that if this is your option B, okay, you probably got here to private lending because you could not qualify for the A lender or even the B lender that was available to you, which might have been a MIC or some other B level sort of lender. But the important thing to really talk about during this part of the conversation is, if this was your plan B and you plan on having it for a shorter term because it's very expensive, right? The cost of borrowing can be significant, sometimes 10 to 15%. The idea that once you're done your project, you're going to inherently be able to qualify now for the A lender again is something that I find a lot of novice investors or beginner investors really run into. And that's problematic because you are more than likely, you haven't likely changed your financial situation a whole lot in the past 3 months, right? So I think a lot of people kind of overlook this and they don't really consider the fact that these short-term loans are very, very helpful to get you into a deal, but they can also be pretty dangerous or at least very risky in terms of exiting that financing. So I think it's really important to consider exit strategies here when you're actually doing your project. I think people do good strategic renovations for a reason. Like you would want to do your kitchens, bathrooms, flooring, landscaping, lighting, paint. Those are the things that we can do that increase the value of the property more than our input costs. And so those are great tools to raise the amount of equity you would have in the building. But I still think a lot of people don't really understand that you're still going to want to go back to the A lender or B lender to go and refinance this property after you've utilized that private loan. So I think this is a good conversation to have because people need to understand like there are more costs. And while it makes real estate accessible, and that's great, you also need to have a plan for how you're going to get out of that financing. And, maybe that's a sale of property, or maybe that's a refinancing strategy. But either way, I think your buyer too, I wouldn't count on having fast closes from your buyer if you're going to sell the property, because they're going to run into the same issues of backed up appraisals, backed up everything, and general congestion in the financing system itself. So I think this is a good conversation to have, right? Is to just make people aware that there are additional costs, but it can really help you. And then the important thing is to have a good exit strategy out of here.
Yeah, 100%. I mean, definitely for real estate investors, which I'm sure most of the viewers are either getting into or already involved in it, and they're looking at, how do I scale, how do I grow, how do I solve some problems I'm facing. That's huge. I would say with any real estate investment deal, that's almost one of your top priorities. Is finding deals is great, but the whole thing is how do you want to see this thing grow and or like exit potential private financing situations. And to your point, if you were really struggling to qualify for a good institutional A or B lender, and you couldn't get it, and you were quite a ways off, if your private loans, which most of the time max is like 12 months, not a lot of private lenders sign on for more than 12-month term. To your point, even in 12 months, is your financial situation going to have improved that drastically? And so if the answer is likely no, it wouldn't, then you need to know, okay, so how's that exit strategy going to work with the private lender? Will there be a significant amount of equity increase in the property since I've taken ownership of it? Like, are we really ramping up and improving the property significantly so that even though your financial abilities to qualify for the mortgage might not have changed significantly, the value of the property has. So it's a lot easier for them to process an A or B institution lender because the property is just worth more, right? So that might be one way to navigate the really good situation that you pointed out, which is be really careful. Don't just jump into the deal with the private money without an ability to pay the private money back. Is what you're obviously saying, which is crucial.
Yeah, I mean, the cost basis is just so high, right? Even if you had your property at a cash flowing state, the actual cost of a private loan could eat away at that pretty badly. The nice thing is when you go to refinance these products, obviously work with a great mortgage agent, just like working with Carson Law for your legal, where they're focused on real estate. Work with a real estate investor focused mortgage agent as well, so that you can actually get great advice and great counsel on what products are best suited for your investment properties, so that when you refinance, they'll factor in the actual income from the building that you're working on and use that to help you qualify for more money. And I think that's important to understand in kind of how things just work between private and public. Another thing that we talked about that you didn't quite cover, but I know I get asked this a lot, is do we still need appraisals with private lenders?
I mean, it probably depends private lender to private lender. I would say the majority of them still ask for it because it'd be part of likely either the lender's due diligence or the mortgage broker who's working, with the private lender's due diligence. I mean, ultimately, because it's a private lender, they can do what they want, right? For them, it's an investment no differently than it is for you taking on their loan, so to speak, and acquiring the real estate property. So they don't have the same rules and restrictions and regulations that the banks do, and the credit unions and the kind of the B lender groups that are still institutionally governed and so forth. But they're not your top 5 banks, right? If you're truly a private lender, it's kind of the Wild West, so to speak. There's other than what you've got in your mortgage commitment and your term sheet, you don't have to get an appraisal. But I would think the majority of the private lenders we either deal with as clients of ours, or the ones that we see lend to our clients, are looking for appraisals as one of the due diligence items to value the property and satisfy them that this is a good loan for them, meets their risk appetite and so forth. So I think it's still something you're going to see even on the privates most of the time.
Yeah, I agree. I think every private loan I've seen or helped on has had appraisals involved. And I don't think people talk about that a lot because they think, oh, well, no, it's private. So, obviously I'm getting into this property either because it's in a state of disrepair, or it's got low income at this point, or something else is going on with the property or my own finances that doesn't allow me to qualify using traditional means, doesn't mean they're not going to use an appraisal. Appraisals, by the way, for anybody that's maybe just getting started, have a lot involved in them, and inspections. If you get an appraisal and an inspection, you're going to know a lot about the building, but you're also going to know a lot about the neighborhood and its potential, because they're going to use different models. They're going to use the income approach to really look at what market rents are in that area and what the potential of the building could be if you state to them what improvements you're going to be doing. So they're going to be looking at the income approach. They're going to be looking at cost of replacement. They're going to be looking at what the actual comparable sales have been as well. And I think that when they use all three of these strategies to really evaluate the value of the building, it's going to give the lender a really good idea about what the future value of this investment actually looks like, so that they can protect themselves from market forces or anything happening to their principal. And we always talk about this in terms of principal risk. They don't want to put their actual principal, the money that they're giving you, at risk because either you're not going to execute on the actual implementation of your improvements, or if the market's going to correct a bit. They need to understand that. And I think that's part of private loans, is they may give you a higher loan to value, which is all the reason why they need to do more due diligence. So I think it's very reasonable for them to ask for appraisals. And I think it's very reasonable for anybody who's considering doing a private loan to account for the cost of that appraisal, because it's definitely going to get forwarded to you. So just taking a look at this, and before we wrap this video up, Ryan, we've talked today. So with private loans, we've talked about there's appraisal cost, right? There's legal cost, potentially times two. I've definitely seen it in my experience where I get to pay both sides of the legals, which is, it is what it is. What would you say the legal costs are to execute on a loan like this? On average?
Yeah, like privately, you're right. The lenders almost 9 times out of 10 they're not paying any costs. It's all going to come off the advance amount. So if it's $100,000 loan, broker fee, lender fee, their lawyers' fees, all are getting, taken away, from that 100,000. And then you're just kind of left with a net amount as a borrower, right? I would probably say a lender's legal fee, for an average loan file is probably, with fees, taxes, and disbursements kind of all rolled into one, you're probably around $2,000.
Okay.
So it could be less. It could be down as low as 1,000, but could be a little bit north of 2. It really depends, I think, on each lender's lawyer and maybe some of the parameters and work involved in the deal and the property itself. But 2,000 gives you kind of a ballpark, I think, to work with. And then it's just really a question of, is it on the lower end? Maybe it's only around 1,000. Is it on a higher end, like 3,000? I've really seen it kind of all over the map, but in that range is probably pretty much catches everything, I think.
And I think it's smart here to budget for the worst, right? Plan for the worst, hope for the best, and then make a great implementation plan that hopefully, allows you to achieve that. So I think, what you got to think about if we're dealing with private versus a traditional lender or a institutional lender, we got to think about appraisal costs. We got to think about lawyer fees or legal costs. We've got to think about the actual lender fee and potentially a broker fee as well. So, this is anywhere from 2 to 3% of the actual principal amount that you're borrowing. And so with all that kind of wrapped in, and then the actual rate itself, your total cost of borrowing is going to be a bit higher. But if you understand these things going into these loans, and you understand that you need a little bit more time for closing so that documents can be arranged, they can shuffle around all the paperwork, money's waiting there for your seller on closing day, so you don't run into issues of having to renegotiate price or give consideration because you were late to the table. If you can do these things and budget for these things, I think private lending could be a great tool to get into more opportunities, or to potentially get into opportunities that are in greater distress and should therefore have more potential for returns, right? The greater your risk, generally speaking, in investments, the greater opportunity there is to get a lift on the value. So I think these are a great tool. And thanks again, Ryan, for coming on. It's actually just fantastic to be able to access, a lawyer's time, especially, on something that's free like YouTube. So it's really fantastic. We appreciate you having here. How can people get a hold of you if they want to actually solicit your services? How do we get you?
Well, you can just check us out at our website, carsonlaw.ca. So CARSON, all my contact details there, as well as my full team. And we also have some of our own, channels as well. So follow and like us on, Facebook and Instagram and YouTube as well. And check out our own resources and videos on our website too. So thanks a lot for that.
Yeah, no worries. And thanks again, guys, for tuning back into the Canadian Real Estate Channel. It's guys like Ryan here that give you guys all this free value that you can take home and actually implement. These are real people doing real deals. And Ryan's actually got a ton of videos on this channel. So go back, watch those videos. I'm sure right about now, something's popping up, guiding you to the next video. It's okay. Go down the rabbit hole. Watch all the videos so that you can be informed when you make your next investment. And hopefully that allows it to be even more profitable for you as you guys lead into the new year now. And you can make 2022 a successful year. So happy hunting, guys. Have a great day. And I hope you guys all got a ton of value out of listening to Ryan from Carson Law. Thank you.